Everyone, thank you so much again for joining. I'm Vishal Mehta. I'm the founding partner of Travel and Payments. In my previous roles, I worked at Expedia Group, Microsoft, and Visa. Uh, I started my career with Visa actually, and both at Expedia and Microsoft, I was managing the payments for the Asia Pacific region as a merchant. So, which means I've stayed on the merchant side. With Visa, I was essentially working on the alternate payment methods. So I've stayed on the say payment aggregator side as well. And I've also worked with another company for merchant payments. So I've seen a lot of it. Just to keep things very clear and crisp and the expectations clear, just want to highlight one thing that today's payments 101 is going to be basic, extremely basic if I can add. So please, please ensure the expectations are right. We are going to walk through a few elements, and this is the agenda which we have. First is we are going to do introduction of payments very briefly. We'll get into the cards, what are different types of cards, and then comes the most important topic, which is transaction flows and components. And then we'll also talk about the payments health and performance. So we'll try to wrap this up all in say 30 to 35 minutes, and then we'll leave about 10 to 15 minutes for questions as well. And Anupreet, who's our operations manager, she's going to share the Slido link as soon as I start the conversation. So you can start putting up the questions on Slido, upvote, and we'll start picking up the questions right from the top. All right, so let's get started. Okay, first things first, right? Introduction to payments. So payments is nothing but money, movement of money. I think my business partner, some of you who may nicely know, she was working at Uber, and her payments team was essentially called money movement team. And I think that was a very right and apt description. End of the day, we are responsible for moving money. Though when we talk about payments and card payments specifically, the onus of the payments team usually ends at treasury. Essentially, the moment the money hits the bank account, what happens after that is typically what treasury teams manage in different organizations. But when we think about money, the first form of money was essentially a barter system. It was not money exactly, but people used to exchange goods with each other so that they can. I mean, that was one form of payment, right? Like, let's say I grow rice, I want rice, someone else grows vegetables, so we exchange rice and vegetables between ourselves in order to make our house complete. But soon there was standardization coming in form of gold. So gold was a money standard for the longest period of time, but also mining gold was not easy. So which created the famous gold rush of America, Mexico, and other places. So gold was one standard which lasted for a long time. However, as more and more metals started being mined, which were cheaper to mine versus gold, and it became, we moved into metal coins. Every empire in the past, in the history of the world, which came up, they had some form of metal coins which were unique to that particular empire. And of course, in the last 100 or 150 years, we started with paper money. So paper money became cheaper to produce, and hence, you could assign higher value to the same form of paper money. So, end of the day, money, like when you develop like gold metal coins of paper money, it also boils down to what is the cost of development of that particular currency. And electronic money. Electronic money, we talk about electronic money in the form of cards, essentially cards, but also we have other alternate forms of payment method as real-time payment systems, which also form part of electronic money per se. Right, and then of course cryptocurrency and stable coins. Now, we were talking about the cost of production of money. And paper money really reduced that. However, we've seen with crypto that the cost of production of the money has increased, but the value it denotes or it keeps has changed. From an evolution perspective, it has been a significant evolution. Today, even like if we talk about the generation alpha, they're probably living in electronic money, and by the time they start earning and they start hitting the job market, they probably may not see paper money again. We don't know, right? But with all the changes which have happened in the evolution of money, we are going to focus right now on the electronic money. So when it comes to electronic money, we talk about what are different types of payment methods of money movement which is there. And the first thing which is obvious, which everyone thinks about electronic money, is cards, right? And when it comes to cards, there are four types: credit, debit, charge, and prepaid. We'll dive a little deeper into what are the different forms of cards. Then, of course, real-time payment methods. Real-time payment methods, instant payment methods, typically UPI in India, Pay Now in Singapore, and PayTo in Australia and different other places. And then there's, of course, Pay by Bank. Pay by Bank is essentially NEFT, RTGS in India. You have Gyro, Fast in Singapore, and other places, right? QR code payments is one form of instant payments. It's just a different user experience compared to the typical instant A2A transfers which are there. And then we have alternate payment methods. The funny part is when I did these payment 101s about 6 to 7 years ago at Expedia. I mean, when I was working at Expedia, I did payments 101 for at least 10 different offices of Expedia with different teams, and that's where I really took the passion of educating people about payments. That real-time payment system was one of the boxes under alternate payment methods, but now it has become a behemoth of its own. There are so many countries in which real-time payment systems has a higher market share than cards themselves, and which is why it deserves a category of its own. But today, we are only going to focus on cards because if you talk about the entire payment stack, 1 hour is not enough. Perhaps we may do payments 2 at a later time. But when it comes to payments 101, card payments 101, we are going to focus specifically on the cards. So when it comes to cards, what are different types of cards? A charge card. You may have an American Express card, especially a platinum, which is typically a charge card. Even corporate cards are charge cards. Charge cards mean whatever you gather throughout your billing statement, you have to pay in full. Typically there's no option of delayed payment or carry forward payment and all, which is what credit cards offer. In credit cards, you'll have a minimum payment value, which is, I would say, pay later in partial, or you can pay later in full. So charge cards, typical cycle of charge cards is 20 to 50 days of credit. Credit cards also is 20 to 50 days. However, there's an option of absorbing higher interest rate, but pay a smaller amount upfront rather than the full amount later. And then, of course, debit cards. Debit cards is nothing but a direct debit from your bank account. It is attached to the bank account frequently. And this is what is being replaced by A2A payments, account-to-account payments, or real-time payment system. Debit card has kind of taken a significant beating when it comes to end of payments. Then prepaid cards. Prepaid cards, you already paid for it. I mean, it's slightly different than debit cards because debit card does not have a stored value by itself. Debit card is attached to the bank account, so whatever amount is there in bank account, that's something which which is the kind of amount you can withdraw from the debit card. But prepaid card, you've already paid for it, and the stored value lies on the card itself. You can top up that prepaid card, but the stored value itself is is part of the prepaid card. So these are the typical 4 types of cards. Now, when it comes to understanding your card, right? Like if typically those who are new to cards or those who are new to the concept of BIN numbers and card types, etc., I would urge you to take out your cards from your wallets, and if they are something really close by. The most important number for any merchant, any acquirer, any issuer is the PIN number, the first 8 digits of the card. Until 5 to 6 years ago, the first 6 digits of the card was called the BIN number, and now both Visa and MasterCard have expanded that definition to the first 8 digits of the card. BIN is nothing but bank identification number. So every digit in those first 8 digits has a meaning, right? If you look at the number 4, 4 typically means that you know that the card is a Visa card. Like if it is MasterCard, it would start with a 2 or a 5. American Express would start with a 3, and similarly, different types of cards in the world start with a different number. Typically there are many websites you can go and say that BIN search. If you just do card BIN search, and you will come up with the top 3 or 4 results. You put in your first 6 or 8 digits of the card, it will successfully identify which country your card is from. Is it a debit card or a credit card? If it is a credit, what type of credit card it is? Which bank has it been issued in? Is it like a signature, which you are seeing on the card type acquiring? Is it a platinum? Is it a corporate card? Is it a prepaid card? Is it a virtual card? All these values you will be able to understand just by looking at the PIN. And which is why most of the merchants will store the first 6 digits of the card or first 8 digits of the card, depending on whether they have PCI compliance or not, which we will get into at a later stage. What you are seeing here as card type, I mean, of course, this is a card network, which you are saying, and then the card type signature. This is the acquiring card type, and we will talk about the significance of the acquiring card type as we move towards the cost of payments as well. And of course, this is called the issuer. Issuing bank or the issuer is the same thing. Acquiring bank or the acquirer is the same thing. And then, of course, we have the card network, right? Okay. So that is about the card. And now let's talk about the different transaction flows and the components. See, there are 2 types of transactions. There are 2 types of transaction flows. The first type is what we call as the open loop. So your Visa and MasterCard are typically open loop, which means Visa and MasterCard kind of act like like an intermediary of only doing the technology work, right? I mean, typically Visa and MasterCard are network systems which have built strong layers and different systems within its place. However, they don't work with the consumer or the merchant directly. They typically work with what is called as an acquiring bank and the issuing bank. So this is what we call as an open loop system. On the contrary, a closed loop system is like a card network which has a relationship with both the card holder and the merchant, which is like typically you will see the American Express, JCB diners, I mean JCB not to so much extent, but American Express and diners having a direct relationship with the merchant. So, in the simplest of terms, you can think about open loop system as a B2B network. With nodes separated, and a closed loop system as a B2C network. However, of course, times have changed. You have cards which are co-branded with American Express and an issuing bank. You have cards which are JCB and an issuing bank. So you have all sorts of those things. But typically, there are 2 types of system. One is the open loop and the other is the closed loop. So who are the key players in any credit card transaction, right? The first key player is the issuer. Issuer is for people like you and me as an individual. When we receive a card from a bank, that is called the issuing bank. And typical examples of issuing bank: UBS, Deutsche Bank. Back home in Southeast Asia, you have BPS, you have UOB, OCBC. In India, you have HDFC Bank, ICICI Bank. These are all typical issuers. They maintain the direct relationship with the consumer. They are the one who underwrite the credit risk. They are the one who issue the cards, and majority of the legwork is done by the issuer. And then you have an acquirer. Acquirer is basically someone who has a relationship with the merchant, right? So you have a merchant where acquirer has a relationship, and then you have the issuer where the consumer has a relationship. So these are the 2 different. These are the 2 key players in any transaction, in any credit card transaction. You can also think from from a check perspective, right? When you are issuing a check, you are issuing a check to on your own bank, and you are depositing the check in the receiver's bank, right? So the receiver of the money is what we call in card terms as acquirer, and the issuer of the money is what we call in card terms as the issuer, right? And then there are card networks. So card networks, American Express, MasterCard, Visa, these are the typical card networks everyone knows of. A few years ago, Discover and Diners Club merged, and that's how the Discover. Now they are in a single network. Of course, JCB has spread much beyond Japan. JCB stands for Japan Credit Bureau, and then China Union Pay as well. And then you would see every country has its own card network. Like India has RuPay, France has Carte Bancaire, Netherlands has Ideal, and then you have in Belgium there's Bank Contact. Of course, they are bank kind of payment methods, but also they issue debit cards. You have Interac Online in Canada. So you have different forms of card networks which are there. But the 6 which you're seeing on the screen are the global card networks as such. But it doesn't end at that, right? You have issuer, you have acquirer, you have card network. But what comes next? You have the payment gateway. Now, payment gateway is essentially, we'll talk about payment gateway, how it fits into the whole scheme, but payment gateways you can think about as optional parameters, optional characters. It's not always mandatory to have a payment gateway in the transaction. Neither is it important to have a payment orchestrator in the transaction, nor is it important to have a payment aggregator in the transaction. So the three elements we are seeing are almost omnipresent, but they are not mandatory. They make the life of the merchant much easier compared to, let's say working with the acquirer directly. We'll talk about that how, but payment orchestrator is really the new term. I would say payment orchestrator is nothing but a payment gateway, but on steroids, right? It offers much more than just pure connection with the, with the card networks or with the acquirers, which a payment gateway does. It helps route the transaction. It helps identify what is the lowest cost in a particular route. It helps, majority of the merchants to onboard multiple payment providers, multiple payment aggregators, multiple acquirers in a single integration, which the payment orchestrator does. Now, typically, if you look at the companies like Microsoft, Expedia, Amazon, which are big companies, right? Now at Expedia, we had a payments team, and I'm being very specific here, we had a payments team which was only involved in acceptance of payments, right? So it was $40 billion of transactions which are happening every year, which are of course now grown to $50 to $60 billion of direct consumer sales of hotel and flight bookings, which are happening directly. There was a team of 110 people managing that flow. 110, right? You have product, you have technology, you have analytics. Because if you look at the average cost of transaction, it's 2%, and 2% of $40 billion is $800 million, right? So 800 million, it is $800 million. So $800 million are being paid by an OTA like Expedia just in transaction cost, and it's just 2% of that. So to manage that 800 million cost and ensure more and more transactions get successful, you have a specific payments team to manage different elements of that. We can talk more about that as we grow, and I can also take some questions. But companies like Expedia have these large teams. Now, smaller companies, which are, let's say, processing less than $500 million or $100 million, they cannot afford large teams like Expedia. So what do? They work with payment aggregators, they work with payment orchestrators, and they work with payment gateways in order to make some aspects of that payment integration much simpler than what it is today, right? But so this is about the different players in the credit card transactions. You have issuer, you have acquirer, you have card networks, and then you have payment gateways, you have payment orchestrators, and you have payment aggregators, right? So these are the 6, and of course you can include many more players and many more layers in there, but these are the 6 which you need to know from a merchant standpoint. What are the different elements in a card transaction? Now, before I go ahead, I will invite Anupreet to talk a little about who we are at Travel and Payments, what do we do, and essentially explain about us. Anupreet, over to you.
Thanks, Vishal. Yeah. Hi, everyone. I'm Anupreet, the Operations Manager at Travel and Payments. So yeah, before we move on to the next part, I'll just take a couple of minutes to give you some context on who we are and how we operate. Vishal, can you please move to the next slide? Yeah. So talking about our vision is basically based on 2 core pillars. First is democratizing payments knowledge, which we try to do through webinars like this, our payments educational one-on-ones, which we publish on a monthly basis, and the Did You Know series that we do on a weekly basis. The idea is very simple: share knowledge with each other, learn from each other, and contribute to shared growth so everyone can benefit from the shared knowledge. And second is that payments should always be treated as a strategy and not an afterthought. Most of the times, payments come in much later in the process, and that's the reason why a lot of friction starts to show up. What we're trying to do is shift that thinking a bit, help businesses look at payments as something that needs to be thought very well early on as part of the core strategy, and that only ties into our mission. We bring clarity, honesty, and real-world experiences into those decisions that are to be made early, so payments can help support the growth later and not become a problem to solve. That is what we do, helping businesses navigate payments without any confusion, any friction, and without any costly mistakes. Vishal, can you please move to the next slide? So coming to what we do, our unique propositions. First is the payments advisory. We provide payments consulting and advisory services to businesses. We are a group of 5 partners, Vishal and Chi being the founding partners, and Kanika, Arvind, and Janet being the partners. And they have already spent collective 100 plus years across the payments ecosystem. We are also supported by 50 plus consultants who are domain specialists across this payments value chain. Second is the Payments Club. Well, we are all here because of that. For those who may not know, Payments Club is this group of payments enthusiasts across the globe who enjoy discussing ideas, sharing insights with each other, and contribute to the future of payments. It's a brainchild of our founding partner, Chi. We started with about 30 to 40 close connections, and today it's grown to 700 plus people globally. We host regular webinars like this and also do quarterly meetups in Singapore. And alongside that, we've also taken the community to different regions, which includes the US, Dubai, Thailand, Malaysia, Philippines, and India. And by the way, the next one is happening in India this June across 4 cities, Mumbai, Bangalore, Delhi, and Hyderabad. We'll be sharing the registration details about that very soon. Coming to the third part, which is the payments education. So we keep publishing monthly one-on-ones on specific payments topics. The goal here is to help newcomers or the new guys in payments understand the concepts without getting overwhelmed by the jargon. And also who have already spent a lot of time in payments but just want to revisit the basics or just brush up on the basics. This is good for them too. And last is the employer of record. This is something we've recently added in partnership with EXT India. So the companies can hire and operate in India without setting up a local entity. We manage all things compliance, payroll, employment, all of that. Yeah, so this is about the employer of record. That was just a quick overview of who we are and what we do. I'll just pause here and hand it back to Vishal to take us through the next part. Over to you, Vishal. Thank you.
All right, thank you so much, Anupreet. So I really appreciate that. Now, let's, Samir, I also saw your question. I will address that question. There are a couple of things which you would love to know before I answer that, so you understand what all can be negotiated, right? But when it comes to card transaction flow, what do we have, right? What are the key relationships? We already heard about issuing bank, we heard about acquiring bank, we heard about card network, and then we also heard about payment orchestrators and gateways and aggregators. But I'm going to show you the simplest form of card flow. So what happened? What's the first step in order for any card transaction to happen? The consumer needs to have some form of card, whether it's a credit, debit, prepaid, or charge card. And that card is being issued by the issuing bank, which is also called the issuer. So the first step is essentially issuer issuing a card to the customer. So then customer would typically visit the merchant website. It would enter the card details. The merchant will send the card details to the payment orchestrator, and the payment orchestrator will route the transaction either to the payment gateway or directly to the acquiring bank. So you see, the payment orchestrator works with payment gateways and also the acquiring bank. The merchant also can work with the payment gateway and the acquiring bank. But in many big companies, the merchant can work with the acquiring bank directly. So this particular flow you are seeing, this entire flow which you are seeing is essentially there can be those 4 parties, or there can be a single party as well. It's not necessary to have all the 4 parties there. So after the payment transaction hits the acquirer, what happens then? The acquirer will send the transaction to the card network. Acquirer has special capabilities to work with the card networks and route the transaction to the right card network, whether it's Amex, MasterCard, Visa, Discover, etc. And of course, the card network will identify what is the issuing bank, and based on that, take the forward. Now, see, in this whole picture, that BIN number which we spoke about earlier, that is a very important piece, because BIN number will identify from acquiring bank to the issuing bank how the transaction is routed. Acquiring bank will decide that the first digit of the BIN is 4, so which means it identifies at Visa, so it will send to Visa network. If it is 2 or 5, it will send to MasterCard network. So acquiring bank necessarily needs to have those capabilities in order to identify where to send that particular transaction, and of course a complex web of ERP tools and settlement and reconciliation tools in order to actually make that happen, right? So those are the relationships. But what is the first step in any card transaction? The first step is called as authentication, right? So in authentication, imagine the customer visits the merchant website for the first time, and the merchant will initiate a communication with an MPI. MPI is called the merchant plugin. Now, merchant plugin is different from an acquiring bank. Sometimes the acquiring bank also offers the services of merchant plugin. Sometimes acquiring bank will connect with the merchant plugin directly. And sometimes the merchant will use another payment gateway to connect with the merchant plugin. But end of the day, merchant in one form or the other will send the card details to an MPI server. MPI server will check with the card network directly and say that, hey, I have this particular card. I want to initiate an authentication check on that particular card, right? Then card network will identify the issuer and it will send the transaction to an ACS server. ACS is called Access Control Server. And this ACS is responsible for that authentication layer between the issuing bank and the card network. So this is what happens, right? And all of this happens in a split of a second, right? Essentially, all your OTPs, two-factor authentications, in order to process the transaction when it comes to cards, are going through this particular route, right? Merchant is sending to MPI, MPI is sending to card network sending to ACS, and ACS sending to the issuing bank. So this is complex. There are some acquirers and some MPIs who charge anywhere from 0.02% to 0.1% to do one authentication. It really depends on the cost of the transaction, right? So that's the first step, authentication. Once authentication is successfully done, then comes the authorization. So what is authorization, right? So in case of authorization, the merchant has anyway captured the card details from the customer. So merchant will add the authentication data and send the transaction request to the acquiring bank. Then the acquiring bank will take the transaction data along with the request and send it to the card network. And then card network will send to the issuing bank. And in response, we will get, the response whether the authorization is successful or not. So typically, when you check into your hotel, you swipe your card, and they identify and they tell you that, okay, we are blocking $1,000 for the room, for the rooms for 5 nights. So you say, okay, and essentially it is nothing but just the authorization layer. So what the issuer is doing is blocking $1,000 on your card from being used in future, so that when the acquiring bank or the merchant is going to request that, okay, now I want to settle this transaction, which is the next step. We call that as clearance, capture, settlement, all of that being the same thing. So in case of settlement, whenever merchant wants to, it will capture those authorizations in a single file or an API and send to the acquiring bank. Then the acquiring bank will collate all the files together between various merchants and send that to the card network for clearance. And then card network will identify which clearance to be sent to which issuing bank, and based on that, it will process the transaction. So first we learned about authentication, then about authorization, and now about clearance. So these are the 3 essential steps in order to complete a transaction, right? But clearance is not enough. What comes after clearance? Settlement and recon. So what happens there? So after the transaction is captured or cleared, then the issuing bank has to send the funds, right? That funds are first sent to the card network. But remember, in the open loop, Visa and MasterCard are not banks. They don't have licenses in most places to be a collector of funds. So what Visa and MasterCard will have, they will have their own merchant banks. So what Visa and MasterCard will do is it will tell the issuing banks, that please send these number of funds to a particular network bank, and that is how the acquiring bank will receive that particular settlement amount. And from there, acquiring bank will settle with the merchant after keeping its share, and it will also provide the reconciliation layer. Right? It sounds simple, but of course it's very complicated. Processing a transaction is easy, but the settlement and recon usually takes anywhere between 24 to 48 hours. And there are some countries like Brazil, for example, where the settlement actually happens every 30 days. So once you perform the transaction, it will take 30 days for you to receive the money. Japan is similar. The minimum is 7 days. So it's very complicated, right? But of course, all the payments people and all the payment network make it simple and easier. Right, so we had authentication, we had authorization, we had capture or clearance, and now we have settlement and recon. That completes the transaction. But how much money do we make, right? As a merchant, when the transaction is processed, let's say there's $100 of transaction which has been initiated. Out of that $100, what happens? The issuing bank is going to deduct its own fees and send to the card network. And this fee is called the interchange fee. So Sunny, to answer your question a little bit, whatever amount you can negotiate, etc., it all boils down to that interchange fee. I've mentioned $1 as an example here. However, it can range anywhere from say 0.2%, which is true for debit cards in Europe, where interchange has a cap. There's a regulatory cap on how much interchange fee you can charge, which is 0.2% for debit cards and 0.3% for credit cards. And it can go up to 2.1%, especially for cross-border corporate cards or virtual card transactions. So the range is much, quite high. So issuing bank is going to deduct its fee and hand over the rest to the card network or the card network's bank. And this is where all your miles, your rewards, your cashbacks, they come from. Interchange fee is solely responsible for how many miles and rewards, etc., you make on a particular transaction. So, of course, there's a lot of mathematical formula and financial modeling which go on there, where in some cases you get more value than the interchange fee, in some cases you get less value than the interchange fee, but of course, you can blame the financial modeling there. But to put it very simply, every transaction has an interchange fee, and interchange fee is the one which is the earning of the issuing bank from the transaction. Then what the card network will do, card network will keep its own share and pass on the remaining to the acquiring bank. This fee is called the scheme fee or the assessment fee, right? So this is what the scheme fee and the assessment fees means. Now, the spread on this particular is even wider. The scheme fee starts as low as 0.02%, right? Just 2 basis points, especially for debit cards. 2 basis points is a very, very small amount, but probably the volume of the transactions are very high, and the scheme fee can go up to 1.5%. All the cross-border transactions which happen, the scheme fee on Visa and MasterCard is 1.5%. It's extremely high, which is why you are charged, which is why some of the merchants say that, oh, we won't accept foreign cards, because accepting foreign cards is way more expensive rather than accepting domestic cards. And the primary reason for that is the scheme fee. Then acquiring bank is going to deduct its own fee, right? Let's say in this case, 30 basis points, but acquiring markup can range anywhere between 5 basis points or even 2 basis points if you're really good at negotiation, or if you're as big as Amazon or Expedia or Booking.com. It can range for as high as 1% as well. So it really depends on what your acquirer or what your merchant bank is going to offer you. And this fee is called the acquiring markup. So which is why in payments, you would have often heard of the term IC++, right? So what is IC++? IC++ is interchange fee plus scheme fee plus acquiring markup. That is where the term IC++ pricing comes from. Now, there are, any company which starts nowadays, right? Any startup that starts accepting payments, typically they would start using Stripe if they are an international brand. And if they're in India, they would typically start using Razorpay because it's easy to use. It provides you predictability, right? Stripe's fees is standard, it's flat. PayPal's fees is flat. Razorpay's fee is flat, right? Per transaction, it is flat. So what they are doing is they are again using financial modeling at their end and then saying that this is your blended fee. So there are 2 cost models essentially. One is the IC++ model, which you are seeing on this particular slide. And then the second model is the blended fee model, where irrespective of the type of the transaction, irrespective of the interchange fee, irrespective of domestic or international, your bank is going to say that per transaction, I'm going to charge you this much flat, no questions asked. So they are, in general, most acquirers make more money out of blended fee than IC++, even though it's a little more, kind of simpler. So, and finally, the customer pays to the bank $100 in the monthly statement. So you see, the customer gets goods worth $100, but the merchant is only receiving $98.2, right? So this fee, which the merchant loses per transaction, is called MDR or merchant discount rate. That's the other term for that, right? So merchant discount rate comes in 2 forms. One is IC++, and the second is blended fee, right? Again, just to make it clear, All fee values mentioned here just for an example. The interchange varies between 0.2 to 2.1%, and the scheme fees from 0.05 to 1.5%, right? Acquiring markup so vary significantly. So that's about transaction costs. Now let's talk about payments health and performance. When a merchant has its own payments team, there are two key metrics which are the only two metrics matter. The first is cost of payments, and second is approval rates. Any payments team, any merchant, these are the only two metrics which matter to them. Of course, if fraud is also part of the payments team, then also a number of chargebacks is the third metric. But in payments team, where payments is the only KPI which they have, then cost of payments and approval rates. So what are the factors which impact the cost of payments? First is, of course, card type. Whether it's a consumer card or a commercial card. Consumer cards are cheaper versus commercial cards, which are more expensive. The premise being that a commercial card will have a higher spending, so the networks and the acquirers and the issuers will say that I need more out of that. I need more bite of that particular food. Then credit cards are more expensive than debit cards, and of course, virtual cards are the most expensive. So whether your card type is a credit card, a debit card, or virtual card, it really depends on that, right? And then you have swiped versus punched. There's something called as Moto. Moto is going away, but still in a lot of hotel industry, a restaurant industry, the Moto transaction is still very popular, or punched. It is called mail order, telephone order. That's what is meant by Moto. Then there's something called as CP versus CNP. CP is card present transaction and CNP is card not present. So all your e-commerce transactions are card not present transaction, and the transactions which you are doing where you are available, the cashier can identify your card, that is a card present transaction. Obviously, card present is cheaper than card not present because the risk is lower, because they can identify who's the card holder. There's one very important nuance which is happening here. While all e-commerce transactions today are card not present, but card networks are working on technologies where even e-commerce transactions can become card present. A few months ago, we had done a webinar with Visa exactly on this topic. So that was there. And most important thing in the cost of payments, where is the payment process? A domestic transaction is almost always cheaper than the cross-border transaction. There are some examples or exceptions to this, but more often than not, a domestic is cheaper than the cross-border transaction. There's one more very, very key important criteria, merchant category code. Actually, we can have one whole session on merchant category code, but MCC is very important because when you onboard as a merchant to any provider, to Stripe or etc., they will assign an MCC to you. MCCs can be different in different forms. If you look at there's a specific, my favorite example when it comes to MCC specific pricing is 4722. As an OTA or online travel agency, you are assigned an MCC of 4722. In Hong Kong, there is this surprising thing which we discovered only after we went live at Expedia, that the MCC of 4722 has a special pricing when it comes to the interchange fee. It is only 85 basis points. Now, the regular cost of transaction or regular interchange in that market is 1.5 to 1.6% for domestic transaction. But irrespective of the type of card, irrespective of its whether credit or debit, for 4722 MCC in Hong Kong, which is an OTA MCC, the interchange fee is only 0.85%. And the same thing is true in Japan, which is at 0.7%. Of course, there are legacy reasons why this is there. Travel in itself is not a very, especially for travel agents, it's not very high margin business, which is why the card networks and the issuers together will assign different pricing to different MCCs. Like for example, if you're doing grocery shopping or groceries, MCC has the least interchange in any country typically. Right, so that is what it is. MCC based interchange fee and scheme fee are different per country, per region. So you have to be very careful which MCC you're being onboarded on in order to get the best of it, right? But approval rates is the other thing. For example, card present versus card not present have different approval rates, whether it's single messaging or dual messaging. So single messaging is what we call as a sale transaction. where authorization and capture are happening at the same time. While dual messaging is first authorization happens, then capture happens, and that kind of impacts the approval rate as well. The number of hops between merchant and the acquirer, which means how many layers are there between merchant and the acquirer eventually, that will also impact the approval rates, and it is obvious, right? The more the number of intermediaries in between, the higher the leakage. But of course, you have to have a trade-off, right? How many direct acquire connections you can integrate, which is where payment orchestrators and payment aggregators come into picture. Where is the transaction processed? Is it a domestic transaction? Is it an intra-regional cross-border transaction or an inter-regional cross-border transaction? It really depends on that as well. MCC also impacts the approval rates because there are some high-risk MCCs, for example, gaming, right? So when you look at the issuers, some issuers will tighten the screws when it comes to gaming in terms of fraud rules. So typical approval rates on gaming MCCs are much lower than, let's say, groceries MCCs. So it really depends on that. What are the chargeback ratios, whether it's an authenticated versus non-authenticated transaction. There are many more factors. I'm just giving you a purview of what approval rate factors can be there. Finally, we'll talk about chargebacks. Chargebacks are, chargebacks are of three types. Chargeback is nothing but, so for example, if a customer calls you as a merchant and says that, hey, I'm not happy with this transaction or I didn't perform this transaction, you agree with them and you can initiate a refund for that particular transaction. That's called a refund. However, if the customer is not happy with that and customer calls the bank directly, so any cancellation of the transaction which has already been completed, initiated by the issuer or the customer with the bank, is called a chargeback. Now, chargeback can be of three types. There could be an error on the merchant side. It may have created something due to which a chargeback would have occurred. There could be criminal fraud, which is the most frequent form of criminal fraud. The third is a friendly fraud, which means the customer is fully aware that they have performed the transaction, but they are in denial that they haven't. There are some countries, some regions like Europe, like Australia, where customer is more right than the merchant, due to which the friendly fraud is also higher. But there are not many ways of solving friendly fraud as of now. But these are the three top reasons due to which a chargeback would occur. So this kind of ends the monologue which I had in terms of Payments 101. Sorry we had to rush through it because of technical issues. But before I take on the questions, I hand it over to Anupreet again to talk a little bit about us.
Yeah, sure. So yeah, hi everyone. We have hosted previous webinars. The recent one we did was with Jonathan, where he gave an overview of the African payments, and we received a good response. And actually, Africa's payments ecosystem is very fragmented, and that was very new to our payments community, and we got a good response on that. So if you ever want to learn about Africa payments or just want an overview, you can always visit this on YouTube. I'll paste the link in the chat if you want to. And other was the stablecoins one-on-one, which we did with Centra, where Sanjeev, who's the CEO of Centra, gave the overview about stablecoins, and he explained it quite well. Also, we have done, as Vishal mentioned, we have also done a webinar on with Visa on Tap to Everything, and we received 250 registrations and 130 live attendees. So it was like, we keep doing these kind of webinars because we know that payments community, our payments club, needs them. And it's just because of the support of all of you that we are trying to, post these on a regular basis. So thank you so much for all the support. Yes, so that's it from my end. If you ever want to visit this, you can always check out the links. I'll just paste the links in the chat. Thank you, everyone.
Yes, now let's go to the questions. Thank you so much. Anupreet, if you have the Slido active and there are questions that you can present, would really appreciate that. But let me also address the questions which are there. First, let me address Sunny's point. So, yeah. So as a technology company, if I want to issue Visa card for USD for my retail clients, I can tie up with a bank, then Visa, how we negotiate. So typically, this is basically co-branded card, right? That's what we are essentially talking about, or that could be one option. Or the second option could be you create what is called as a TNE card or travel and expense card, or a P card, which is a purchase card. So it really depends on the use case which you have, Samir. Usually, depending on the volumes which we have, what would happen is you would first negotiate with the issuer, and then you would negotiate with the card network. The other way also is to go to the card network directly, and then you can work with the card network will help you find the issuer. So both models are also there. Now, this is something which we as Travel and Payments, we offer as a service in order to help you choose by doing an RFP and others. But of course, you need to have a strong business case. It also depends on volumes, depends on which bank are hungry in order to take the business. So a lot of factors, and if you do not have the network, that's something which we can help in as a consulting project. And how to negotiate. Usually what we do is we do RFPs to choose that. Of course, we provide a business case, what is the expected volume and all. That also defines how frequently we receive the response to the RFP. So hope that answers, but typically what you would negotiate in terms of pricing and etc. would all depend on interchange and the scheme fees together. Then Ryan had the question, is a flow same for honest transactions? No, flow is not same for honest transactions. In honest transactions, there is no card network. Basically, acquirer and issuer connected directly. Typically, in honest, acquirer equal to issuer. Now, in case of American Express, especially if you are directly connected with Amex as a merchant, all transactions are called honest transactions because there's no third party in between. Now in India, HDFC Bank and ICICI Bank have traditionally offered honest very frequently, which actually makes them cheapest acquirers in India. However, times are changing. With network tokenization, the honest has become even more difficult to offer. But of course, there are exceptions, especially if in any particular bank, which has an issuing side and acquiring side, if they talk with each other, that honest becomes easier. Like for example, JP Morgan Chase, while providing honors in US is kind of illegal. It is blocked by Visa and MasterCard. However, there are exceptions. There's something called as ChaseNet, which you can explore. Honors is more frequent and possible in South America and in Southeast Asia. It is more adopted and more accepted as honest transaction. All right. So how does Forex work on cost? Who will be bearing the Forex charges, issuing, network, acquiring? So here's the thing, right? In a typical transaction, the Forex is negligible. It is supposed to be 0 or close to 0 with only a small markup. However, the card network will offer something called as DCC. DCC is called as Dynamic Currency Conversion Fee. So the DCC is applied by the card network both on the acquirer and on the issuer. So what does this mean? Whenever there is a mismatch in the transaction currency and the transaction settlement, or when the transaction settlement currency, the transaction currency and the customer cardholder currency are different, if any of these one is different, that will trigger a DCC. So on the scheme fee, which is already at 1.5%, another 1% is added to that as FX fee, and then on the issuing side, also another 1% is added to the FX fee. So on a typical FX transaction, Visa and MasterCard are earning 3.5%, right? 1.5% is a scheme fee, 1% is the acquirer side FX fee, and 1% is the issuer side FX fee. So what the issuer will do will say that, look, Visa and MasterCard is anyway charging me 1%, so let me top it up and earn some revenue out of that, which is where they will charge the consumer and say that, hey, your FX fee is 3.5%, 4%, etc. Of that, 1% goes to the card network and remaining is pocketed by the issuer. So that's how Forex works in a typical transaction. Okay, next one is, could you explain MDR again? I won't bring up the slide again because Anupreet is sharing, but typically MDR is merchant discount rate. Merchant discount rate is nothing but the cost paid by the merchant on the particular transaction. Now, it can come in two forms. First form is IC++, interchange plus scheme plus acquiring markup, which we saw. Interchange is one which the issuing bank keeps. Scheme fee is what the card network keeps, and the acquiring markup is what the acquirer keeps. And the acquirers can sometimes blend it, all of them, and say that I'll offer you a blended rate. So MDR is nothing but the cost of the transaction, which can come in two forms: IC++ and blended rate. All right, the next question: what is the future of card payments considering the challenge from pay by bank, payment methods, and lower rates? That's a debate, actually. I can give my opinion, but that opinion will have value as much as my opinion, not more. So I'll skip answering that right now. But card payments are here to stay at least for some time, right? So it depends on how the world moves ahead. Then the next question is there any card payment where transaction happens between banks only without anyone in between? Yes, that is called as honest transaction. There are two types of transaction: honest and offers. Offers is the typical flow, which I explained. Honest is when the card network is not there. The acquirer is equal to issuer. That would be called as an honest transaction. It is common in Southeast Asia and South Asia. Sometimes the merchant knows that it is an honest transaction, and sometimes the merchant does not know because it does not care. Right? Let's say in Singapore, if you go to the hawker centers, then that becomes like honest transaction, especially if you're issued a card terminal by either DBS or UOB, etc. Then the cards issued by UOB and DBS would typically not go to the card network. It would be an internal transaction. So that's what is honest. Then why are banks issuing card with Visa and MasterCard instead of using own names? See, it's all economics, right? Visa and MasterCard have such a huge network. It is a global network. So you take a Visa issued card and you go to anywhere in the world, it will work because there are acceptors of Visa and MasterCard anywhere in the world. So that is why this becomes important. Now, take the flip side. Take the local networks like RuPay. Take the local networks like in Korea, you have Hyundai Bank, and you have BC Card, and you have so many local card networks in Korea. All of them are what is called as co-badged or dual branded cards. And so the international transactions will happen on Visa and MasterCard. That's the goal. So what Visa and MasterCard over so many years have done is they've created that distribution where if you create your own brand, let's say own bank card, then you have to redevelop that network in order for it to be accepted. So it's easier for you to just work through Visa and MasterCard accordingly. However, it's different with American Express, right? American Express issues its own card, sometimes in partnership with the bank or sometimes by themselves. So, and which is why you see the acceptance of American Express is not as high as Visa and MasterCard because someone has to go and sell and say that, hey, accept my Amex card. So Visa and MasterCard have created their distribution system where they are just an intermediary without being a financial company. Last one, why is a charged card and why do we have to have it? No, you don't have to have a charged card. Charged card is nothing but it's a step above credit card. Anyone who's selling you charged card will say that if this card comes with unlimited limit, right? There is no limit on it. It's a no limit card. So American Express, Platinum card, which are very expensive, of course, right? In US, it costs only $800 per annum, which due to the competition there. In a country like Singapore, it is $1,700 per annum. In India, it is 72,000 rupees. It's a very expensive card. But of course, it comes with a lot of privileges, a lot of benefits. And that's what it is. That's what the charge card is. Also, all the corporate cards, right? The cards which are issued by you to you as a corporate, by your corporate. Let's say, for example, you work for a big company. They'll give you an expense card. Say that, hey, all work expenses, you will put it on this card. Those cards are also charge cards. They have to be paid in full. So, it has limited use, but usually it is a no limit card or it comes with a very high limit. Last one, can cards use SWIFT instead of networks like Visa and MasterCard? No, they cannot use SWIFT. Remember, SWIFT is a messaging system. It does not do anything else. Whereas Visa and MasterCard have a full-fledged payment network out there. It has a lot of relationships between different issuing banks and merchant banks. SWIFT is nothing but a messaging layer. The settlement layer is separate. And this is why stable coins, while they are challenging, challenging the cards, but you also have card networks coming up with cards which are on stable coin rails or cards on crypto rails. Whereas you don't have cards on the SWIFT network because SWIFT is just a messaging layer. Okay, one more question. Can you provide more details about MPI during authentication? MPI is a technology layer between between the merchant and the card network. So essentially, what it does is it identifies it plays a different role than authorization, which is done by an acquirer. So it is just two different parties playing two different roles. Authentication, the two-factor authentication which is done, or in olden days there was verified by Visa, there was MasterCard Secure, etc. All of these activities or this particular technology is done by an MPI, the merchant plugin, and that merchant plugin is only between the merchant and the card network. Just like you have the acquirer, which is between merchant and the card network, similarly you have the MPI between merchant and the card network. The acquirer does authorization, the MPI does authentication. Now, there can be acquirers who also offer MPI services, like RDN, for example, does its own MPI engine. WorldPay has its own MPI engine, but some of them will outsource it to specialist MPI engines as well, like Cardinal Commerce, which Visa acquired some years ago. That provides only an MPI engine. So that is what MPI is. But in order to complete the authentication, you also need the ACS server, the access control server, which is between the card network and the issuer. So the authentication layer is completed using acquirer to card network using MPI and card network to issuer using ACS. So that is what is there. Okay, that last question. But when I transfer between banks using the bank directly, it uses SWIFT for messaging. Why can't it happen in the card system? It's a good question. It's a very technical response which I can give, but happy to receive your question or email and we can discuss this. Happy to provide you the responses offline. So, oh wow, we are quite about time. It looks like we took more than 1 hour, but thank you so much everyone for your patience. Thank you for joining. And again, sincere apologies for the technical difficulties we had, but we will look to do the Payments 101 session again, maybe 2 or 3 months later during the quarter. So thank you again for joining everyone. Really appreciate your patience of going this through. Okay, Wang, you have a question? Do ask. Oh, okay, that must be a false alarm. All right, thank you so much everyone again, and hopefully talk to you soon.
Thank you everyone.